Hey guys, Tanya Bryson here, and I've been getting a lot of comments asking me, Tommy, the market is down right now. I want to learn exactly how to invest and get started into this game. So how do I do it step by step? So here I am making a video about how to invest step by step. And no, I'm not going to talk about day trading and making so much money so you can go ahead and buy my course. It's not the game I'm playing, so I'm not going to do that to you guys, not at all. There's no course, there's no upsell. It's just me telling you what I wish I knew when I was 19 years old, spending all my money on slippers, belts, shirts, and sneakers. Makes no sense, I know, but that's what I was into. I'm sorry, embarrassing story. I should have never said it, but now it's out there. I don't care anymore, okay? Now, here's the core thing, guys. Before we get started, make sure you guys like this video, and on top of that, click the subscribe button and notification bell so you get notified every time I post a new video, which is literally every single day. And hitting the like button, it helps a lot on this channel, so thank you guys so much. Now, before we get started, guys, I do have to assume that you know nothing about investing. Meaning, all you know is that there's a stock market out there and people make money in it, but you don't know how to get into it, you don't know how to buy, and you don't really know what you're buying, okay? Now, for everyone out there that says, well, you know what, investing in the stock market is investing into air, okay? There's nothing to actually buy, it's just digital stuff. The answer is, you can actually get a piece of paper if you want to, like a stock certificate, but it costs money. It's like not really necessary. So the idea is this, guys. The stock market is the home of a lot of public companies, meaning these public companies accept people, normal people like us, to actually go in and buy a small percentage of their company. Now, that small percentage might be 10% of it, 20%, or 30% of it. So for example, if I am McDonald's and I say, for example, well, I want to sell 20% of my company and put that on the market. Now that might be equal to 1 million shares or 200 million shares, like whatever it is. The point is, every time you buy one of those shares, you're buying a small piece of that company. So every time you make an investment, realize that you're buying a small piece of a company, not just a piece of paper or a piece of digital art, like whatever it is, okay? The point is, you're buying a business in a sense. So you have to understand the business, how it works, and all that stuff, which you will know how to by the end of this video. Hopefully, okay? No promises. I'm just kidding here. You will, okay? And on top of that, guys, if you don't know where to invest and how to get started, I recommend, what I use is this, okay? I'll be honest. What I use is Acorns. Why? Because I use Acorns to give me a portfolio based on my risk. I put in money, my money grows over time, and it only costs me $1 every single month. But in reality, my dividends, the money my investments make me, pay for that a long time ago. That's the point here. However, when you sign up, you get $5, which basically means 5 months of basically free Acorns. And if you invest at least $400, well, that way your investments pay for that $1 fee every single month, if you know what I'm saying. That means you get it for free. However, if you want to get started investing and you don't want to pay $1 fee, you can also invest with Robinhood, the Cash App, or for example, SoFi Money. These are all great options for you also. However, okay, let's get started here. When it comes to investing, you have 3 types of people. You have the active type of person, the inactive type, and on top of that, also the passive person. Now, most people out there are actually the inactive type, the people that actually go ahead and they invest with their company and they pay that 1% management fee and they think they're doing a great job. But by the end of the video, you'll realize why that's the most expensive way to actually do it and probably the worst way to actually do it. I'm getting very emotional here. I'm sorry, but it hurts me whenever I hear people throwing away money without knowing they're actually throwing away money. Kind of like a scam, to be honest, right? However, the first way is active investing, which is the most popular one and the one I wanted to get into, to be honest with you, when I was 19 years old and I first heard about stock market investing. Now, the idea is very simple, guys, okay? The idea is that you want to buy a company. For example, if you want to buy Apple, you want to buy it and you want to sell it within a year. That's basically what active investing is. And some people take it to an extreme, and what they do is they day trade. So every single day, they wake up in the morning at 9:30 a.m. when the market opens, and they start buying and buying and buying, and they sell right then and there, and that is called day trading. And that's why every single time you watch a video on YouTube, even this one, it might happen here, you always hear some random guy saying like, hey, I'm a day trader. I'm the best in the world. I don't know how all these guys can be the best in the world, but you know, let's just give it to them, okay? And they always come on here with like all this money, but in reality, most of the time it's fake prop money. All they want to do is sell you the course, buy my program, buy my book, but that's not what I'm doing here. That's not what I want to do here, okay? By the way, statistics show that 80% of day traders actually lose money every single year. So if you want to play a game, just understand that every single year you might be losing money. The risk is very high with this game right here. Now, guys, for active investment, here's some pros and cons here, right? The pro is that when you invest, you might make a lot of money in a very short amount of time, because in reality, most people that invest in the stock market for the long term make around 7% every single year, but in reality, you might make 100% or maybe 200%. But here is the risk, and here's the con to actually investing actively every single year you're buying and selling, okay? The first thing is this, right? It's more risky. So for example, guys, say you love movies, right? And you said to yourself, well, I'm going to go ahead and I'm going to buy AMC stock, right? Or for example, say you also love traveling. So you said to yourself, well, you know what? I'm going to buy AMC because everyone watches movies. And on top of that, I'm also going to buy Delta because everyone takes flights. So it makes sense. However, you did this in January. So January comes along, you made some money. February came along, you made some money, and then March comes along, and you just lost 50% of all of your money. That's the main risk with doing active investing and trying to like make a quick profit, because you don't know when it's gonna go down very hard. And that's why whenever you do invest, by the way, I'm not your dad, these aren't rules, but these are my rules. When I did active investing into separate companies, stuff like that, like Apple or Delta or Tesla, whatever it was, I always had a rule. And the rule was I sell at 15% or I sell when I lose 15% of my money. That was the rule. If you don't keep the rule and you say to yourself, well, you know what? The airlines are gonna bounce back up. Well, now they're like at 50 to 7%, okay, but now they're like at 50 to 70% in losses. In reality, you would have lost a ton of money. On top of that, that's not all, guys. The government also makes it so active investors actually have to pay them more money. How? Is that legal? The answer is it's the government. They make the rules, bro. Like, it's not no fair stuff here, okay? I'm sorry to tell you. However, the main idea is this, guys, okay? You have short-term investments and you also have long-term investments. But on top of that, you also have long-term capital gains tax and also short-term capital gains tax also. Now, tell me, what the fudge is this? You know, well, whenever you invest money, your overall goal is always to make money, right? So if you buy a stock, you want to go and basically sell it for more money, and this way you make more money, right? That's the entire idea here. It's not a trick. However, the government says, well, if you bought a stock and you sold it within a year and you made money, you have to pay us more money in tax. And here's why. They tax you as ordinary income. And usually ordinary income might be 25%, 30%, and sometimes even 40%, depending on how much money you're making and how you're filing. However, if you're going to sell literally 1 year and 1 day after, that is considered long-term capital tax, meaning you could be taxed at 0% or 15%, or for example, even 20%, but no more than that. So the answer is the government incentivizes you to actually invest for the long run. And according to the government, the long run is 1 year and 1 day according to tax law. That's how that works, okay? Now, here's my real thing here, okay? If you want to actively invest, I'm not against it. But I am against people that just want to invest basically because they say like, hey, I like Apple, I like Tesla, I like all this stuff, so I'm gonna buy it. It's all good. But now people are losing money and they're like, oh, I liked it, but it just lost money, man. What's going on now? The answer is whenever you invest, again, remember, you're buying a small piece of a company. So whenever, for example, you're buying a phone and it's used, what do? You open it up and you check it, right? You're like, okay, so it doesn't have any scratches. It looks good. Let me test it. The battery is great. Everything is in good condition. Well, guess what? I'll actually buy it for a premium. But people, whenever they buy a business, they're like, okay, Apple, great, I'm gonna buy it. No, what you want to do, all the answers to stock investing, guess where they are? They're in the financial statements of those companies. On top of that, once you learn how to read them, you'll figure out very quickly that that's not all that matters. And that's why it's so difficult to do like active investing, because you also have to take a look at the management of the company, because a lot of people out there, for example, one famous one is this, okay? For example, Apple. one of the biggest companies ever in the world, right? Like over $1 trillion, okay? Awesome, amazing, right? However, when Steve Jobs first got the company, when he built the company, he was actually fired from the board. And when that happened, because he left, he was like the manager of everything, the company actually sank down. The products were like non-inspirational, like nobody cared about it anymore. And he built another company called Next. And Next, that company started to blow up also because again, the management was the core of the business. Bad management like a McDonald's or a Chipotle or what do you call it? Like Chick-fil-A, whatever you want to call it, or Chick-fil-A ruins a business, okay? So the answer is you also want to study the management of companies because this is the most important part. And on top of that, even once you're done studying the financial statements and the management, you also want to study the brand, okay? And here's why the brand is so important. Because although right now, for example, Delta might be down 50% or 70%. If you believe in the company, okay, in the financial statements, that makes sense, or the management, that makes sense, they're pretty good, right? And on top of that, the brand of Delta, people love flying with Delta. If you believe in all those three things and they all make sense, well, if you buy Delta right now for a discount, well, when the company goes back to its normal value, you will make a ton of money, okay? Whether that's in 1 year, or 2 years, or 3 months, or 3 weeks, the answer is short-term investing makes sense. But as long as you understand you're investing into a business and you have to do research to understand the business. And that's the main idea here. By the way, I can't teach you in this video how to research and how to do all this stuff because it's like a very long process. But what you want to do is basically go on Yahoo Finance or Google Finance and look up the financial statements. And if you don't know how to read financial statements, just go back on YouTube and search up, well, how do I read an income statements, a balance sheet, all this stuff. And eventually you get really good the more you do it. And this way you will be not just an investor, but one of the best investors. Now, number 2 is passive investing. I know I said an active investing, but I'm gonna leave that one for last because again, it's one of the biggest mistakes people actually make out there, okay? Now, passive investing is exactly what I do. So Tommy Bryson, this is me, okay? This is what I do. And to be honest, it's like the best way of investing. You know, history shows this, but it's also the most frustrating, annoying way of investing also. Now tell me, why would you say that? Okay, why would you say it? Sounds kind of weird, right? The answer is, guys, because the idea of passive investing is investing beyond 1 year and so on, okay? So you want to do basically long-term investing, and you also want to invest into companies or index funds or bonds or whatever you want to invest into, but the point is you're going to be holding it for a very long time. Now, what I do is basically I invest into index funds. And history shows that index funds, although they might go down throughout history, they go right back up and they make money also, okay? So for example, I invest into the S&P 500 by Vanguard. Now this index fund right here holds around 500 different companies, the top 500 companies in the stock market. Now, whenever one company falls, it doesn't matter, it gets replaced. So in reality, it keeps levels, it's very well diversified, and overall, I get whatever the market gets in returns every single year, which is awesome. However, the problem is this, guys, okay? Whenever you see, whether you're an active investor, inactive, or passive, whenever you see your investors losing money, you freak out. You're like, man, maybe I should sell, you know, maybe I should sell. I just lost like 20% of my portfolio. I should probably sell. But the rule of passive investing, active investing, is that whenever you see your entire portfolio or your stocks losing money, what you're supposed to do is, if you believe in them and you understand them and you know the value of them, you're supposed to invest more money into them. So in reality, you're getting things at a discount. However, though, it is very hard to do that. And that's why in March, when I was losing money in my portfolio around 13%, which is crazy because my portfolio is very diversified, when I lost 13%, I closed my eyes and I said, well, you know what? I'm going to believe in history and I'm going to do what all the millionaires do, and I'm going to put in an extra $20,000 into my portfolio and let's see what happens long term. Well, even short term now, I'm up around 18%, okay? And the idea is that whenever you're investing and you know what you're doing, although you know what to do, it's not always the easiest decision to actually make. For example, I know I should go work out right now, but I'm making a video, you know? So the idea is, although you know the answer to things, it doesn't always mean you'll always make the decision you need to make. You need to be strong and have a very high willpower, okay? Which is very important also when it comes to investing and following the rules you make for yourself. Now, lastly, Lastly, is an active investing, the most popular one by far. Now, this is for people that actually have, for example, a 401k or a Roth IRA. However, they themselves don't manage it, but they have a management company manage it for them. And all they do is they get charged 1% every single year. That might be you or your parents or your parents' parents. I don't know who it is, but the point is I know a lot of people that do this. Now, most people say, well, Tommy, it's just 1% of my portfolio. The answer is, well, when you take that 1% and you compound it for inflation, the growth it would have had over time, it actually shows that that actually cost you around 1/3 of your entire profits for your portfolio. And all those people basically did was grab your money and put it somewhere. That's all they did, okay? So that's why I am strongly against any management fees. And whenever any company or any like stock app tries to do that to me, I'm like, hey, peace, I'm out. Don't want to be involved anymore. Because again, it costs you way too much money. So tell me, what is the solution if my company has me signed up with one of these companies? The answer is you might just want to go ahead and get a self-directed 401k or a self-directed Roth IRA. The answer is you're going to be the one doing all the work for yourself. But I don't want to do all the work. Well, I know. And I'm lazy too, to be honest. So what I do is I only invest into index funds. And again, an index fund is basically a fund that contains a lot of different stocks. Sometimes it might contain different stocks in like a certain industry and stuff like that. But the answer is diversified enough so if the market drops, you're still good to go. Now, my favorite one is Vanguard, the S&P 500, and the ticker symbol for that one is VOO. Now, I highly recommend, if you know nothing about investing, okay, and you learn something by the end of this video, I recommend you do 3 things for me, okay? First of all, read The Little Book About Investing by John C. Bogle. Also read The Intelligent Investor by Benjamin Graham. And on top of that, give Vanguard a call and ask them what they can offer you after you read those 2 books. Now, here's why I say that. Because by the time you're done reading those 2 books, you will have endless information and you'll know how everything works and you'll be able to defend yourself 1000%. But guys, that is basically it for this video. Comment down below and let me know this one thing, okay? Did you learn something? And on top of that, what type of investor do you want to be? Do you want to be, for example, active, trade every single year left and right? You want to be passive, long term? Or do you want to be inactive and still pay someone a 1%, 1/3 of your investments just for buying stuff and holding it for you, okay? That's not what you want. And by the way, before I leave, I do have to say this one last thing because I want to be honest. My goal for investing is very simple, okay? I want to make more money, probably just like you do. So what I do is this: by investing the way I do for a long run, well, I'm expected to have around $2 to $11 million. When this time comes, guys, my dividend payments is going to pay for everything.